U.S. media, China's banking sector undergoing its largest ever consolidation. Sad, as the new year approaches, migrant workers across China seek unpaid wages, special police deployed. Blizzards strike China, stranding travelers on highways, hunger becomes unbearable. A-share plunge, CCP punishes 6 major rating agencies, experts analyze. It's all covered in today's China Truths. U.S. media, China's banking sector undergoing its largest ever consolidation. Shortly after Guangzhou eased its home buying rules, Shanghai and Suzhou rolled out remarkably lenient real estate policies. Effective January 27, Guangzhou's policy now ignores homes over 120 square meters and those listed for rent or sale in an owner's property count. On January 30, Shanghai loosened restrictions for non-locals with over 5 years of Social Security or income tax contributions, allowing them to purchase homes outside the outer ring, a major departure from the old, stricter rules. At the same time, Suzhou lifted limits on the size and number of homes one can buy, making the process as simple as having the interest to buy. With local governments eager to sell homes, netizens are wondering if future steps might force people to buy homes or penalize those who refuse home loans. This sudden loosening of home buying restrictions across various regions stems from a January 26 directive by the Chinese Communist Party's Ministry of Housing and Urban-Rural Development, which announced it would grant cities more control over real estate regulations, essentially decentralizing real estate regulatory powers to local authorities. Independent commentator Kai Shinkoan observed that this delegation of power also shifts the blame for any potential real estate crash to local governments. The rapid introduction of market-saving policies by major cities like Guangzhou, Suzhou, and Shanghai suggests an impending significant downturn in the real estate market. Unlike previous downturns, this decline is now in full swing. Kai advises those hoping for a price surge to be cautious and consider selling off properties, indicating this could be the last opportunity before the end of China's 30-year real estate boom. Soon, housing prices, including in top-tier cities, are expected to plummet. Netizens are saying that homes collapsing and banks failing is the trend, with the collapse of the housing market already evident, but the potential failure of banks posing a significant issue. Business Insider recently referenced analysts in Beijing's Bad News, who noted that history demonstrates credit-fueled real estate surges, like the one experienced by China, typically conclude dramatically and bring about significant banking crises. This could also explain why the CCP Central Committee decisively handed over responsibility and authority to local governments. Currently, China's banking sector finds itself deeply entrenched in difficulties. Bloomberg's recent revelations confirm this situation. According to Bloomberg, with financial pressures becoming more evident, China is initiating a substantial consolidation within its banking sector by merging hundreds of rural banks into regional entities. Essentially, the CCP recognizes the excessive bad debts held by rural banks, which are too fragile to bear further risks. In anticipation that the real estate crisis might escalate, leading to situations akin to the rural bank incidents in Hunan that jeopardize political stability, it has proceeded with the integration of rural banks. Nonetheless, Shen Meng, a director at the Beijing investment bank Shanson & Company, pointed out to Bloomberg that merely consolidating entities doesn't address the root issue. He stated, "Binding 10 small boats together doesn't truly create a large ship, leaving the underlying problem unresolved." Sad, as the new year approaches, migrant workers across China seek unpaid wages, special police deployed. As the Chinese New Year approaches, many migrant workers in China are struggling to receive their wages, compelling them to demand unpaid salaries. Authorities have dispersed these groups, sometimes forcefully, leaving some to sleep outdoors. Videos circulating online reveal that on February 2, around 20 to 30 migrant workers converged at the entrance of the China Resources Xiyuan community in Nanning, brandishing banners to demand their wages. In response, the authorities dispatched 40 to 50 special police officers for stability maintenance, who seized the banners and forcefully removed the workers, amidst occasional sounds of distress emanating from the scene. On January 31, incidents of wage protests included workers blocking a Shenzhen mall entrance, Migrant workers lying in front of Wuhan Telecom Engineering on January 30th, employees at a Jiaxing clothing factory being expelled by police on January 28th after attempting to demand wages, and about 10 to 20 workers in Hainan City on January 27th threatening to jump from a building as a drastic measure to claim their wages. Some netizens joked, "This photo could take home an award in a photography contest, its composition is stunning." These omnipresent positive energy posters, though brainwashing, can ironically turn into sophisticated satire. Another user highlighted the plight of many wage-seeking migrant workers left homeless, enduring long stretches on the streets, even in rainy weather, remarking, "At year's end, it seems no one cares." One person declared, "Such a grand year-end under the party's governance." The struggles aren't limited to migrant workers, however. On the evening of January 28, China Merchants Bank disclosed that its supervisory board had unanimously approved a motion regarding the retrieval of performance-based pay for 2022, recollecting a total of 58.24 million yuan, about $8.18 million in bonuses from 2,876 staff members, averaging a wage refund of 20,300 yuan each, about $2,850. This announcement quickly became a hot topic on Weibo, sparking reactions such as employers reclaiming wages from workers. "What's this about? Simply running out of money." An overseas social media post on Platform X declared, "This Chinese New Year is bound to be a thunderous explosion, with everyone seemingly in anticipation." Blizzards strike China, stranding travelers on highways. Hunger becomes unbearable. As the Chinese New Year approaches, heavy snowfall and freezing rain have left many people stranded on mainland China's highways as they attempt to return home. According to CCTV News, by noon on February 3, 115 road sections, including 56 highways, 19 national roads, and 15 provincial roads, were closed in several provinces, including Shaanxi, Anhui, Hunan, Hubei, Hunan, Shaanxi, Gansu, Qinghai, and Ningxia, due to snowfall and icy conditions. Additionally, 1,172 toll booths associated with 121 highways have been temporarily closed. The China Meteorological Administration issued orange-level blizzard and freezing rain warnings on February 3. Over the next 3 days, this weather system is expected to reach its most severe phase, with Hubei, Hunan, Anhui, and other regions experiencing freezing rain and heavy snowfall. In Anhui, residents have measured snow depths of up to 12 centimeters in some areas. In Hunan, some internet users have compared the thickness of accumulated snow to sliced cake. Reports from Star Video on February 2 featured Mr. Liu from Zhengzhou, who shared his experience of being stranded on a Hunan highway on January 31 due to a snowstorm. He had limited food in his car and was extremely hungry. Cover News reported on February 3 about a resident driving from Hefei to her hometown in Sichuan on February 1, but got stuck on the highway. She mentioned, "The road was already very slippery, and I witnessed numerous accidents along the way. Many cars skidded and collided with roadside vegetation. At this point, we can only move at a snail's pace and dare not accelerate." Another woman driving from Guangzhou to Hubei was also moving at a slow pace, despite frequent traffic jams and accidents. She explained that after leaving a service area, the traffic jam began, and she had already been stuck for 3 hours by that point. Unfortunately, her car's battery could only last an additional 4 hours. A-share plunge, CCP punishes 6 major rating agencies, experts analyze. Amid turmoil in the Chinese stock market with A-shares continuing to plummet, the Central Bank of China, PBOC, has issued fines against 6 leading rating agencies. After S&P credit rating, China, was warned and fined 2.12 million yuan, approximately $298,000, and its director of rating analysis fined 30,000 yuan, approximately $4,212. The PBOC also penalized China Chengxin Credit Rating Group, Shanghai Brilliance Credit Rating, CSCI Pengyuan Credit Rating, China Liana Credit Rating, and Far East Credit Rating, collectively fining them 34.46 million yuan, approximately $4.8 million. The PBOC cited violations by these entities, including breaches of the consistency principle, neglecting legal rating procedures and business rules, and compromising independence requirements. The fines on these 6 prominent agencies are seen by many economists as linked to the stark downturn in China's stock market. On February 2, the same day the fines were announced, the Shanghai Composite Index fell by more than 2%, dipping below the 2,700-point mark for the first time since March 2020, indicating significant market distress. Taiwanese economist Huang Shirtsong commented on the situation, attributing the persistent market downturn to economic pressures, such as a bleak outlook for China's economy this year, continuous withdrawal of foreign investment, and low market confidence among the public, all exacerbating the decline. The Chinese stock market has been on a downward trajectory since late last year. As of 2024, it has repeatedly fallen below the critical psychological threshold of 2,800 points, reflecting investors' growing concerns. Liang Xiaohua, a former chief compliance officer at a mainland asset management company, criticized Xi Jinping and the CCP's economic policies, blaming them for the economic downturn. He highlighted the stock market as a genuine indicator of economic health that, unlike other economic metrics which the CCP might manipulate, presents an unvarnished look at the country's financial stability. According to Liang, the ongoing market decline underscores the dire consequences of the CCP's governance, suggesting that only the complete shutdown of the market could conceal these realities. Stock market plunge exposes CCP's fabrications claims of economic recovery. While CCP media outlets like People's Daily and CCTV extolled China's economic vitality, the stock market's crash starkly exposed the regime's economic improvement claims as falsehoods. Liang Xiaohua remarked, the fines were levied because the rating agencies shared opinions critical of the economy, which displeased the CCP. However, there's no substantial legal basis for these penalties. The stock market serves as an economic weather vane. The assessments by these agencies merely mirror the realities of China's economic sectors. The market's decline is independent of these evaluations, not a direct result of them. Several credit rating agencies had previously predicted escalating financial risks in China. S&P China highlighted in its report that the ailing real estate sector significantly escalates the risk of an economic downturn, adversely affecting property sales. Liang Xiaohua clarified, a downgrade in a corporation's rating can sometimes impact its stock. Yet, the broader Chinese economy and stock market aren't swayed by a handful of reports. Post-COVID-19, there was widespread anticipation for economic recovery. Contrarily, the CCP's misguided policies led to an economic regression, affirming the stock market's bearish trend. The CCP intermittently attempts market interventions through policies and financial injections, but these efforts don't alter the market's fundamental downward trajectory. In an attempt to salvage the stock market, the CCP has rolled out several initiatives, including rate cuts and the introduction of national funds to stabilize the market, all of which have been unsuccessful. Huang Shirtsong analyzed, this downturn mirrors the broader negative trajectory of China's economy. A radical shift in policy is essential for market recovery, yet the CCP's inability to enact such changes has led to punitive measures against the rating agencies. By downgrading the outlook or ratings of China's stock and national ratings, these agencies triggered capital flight and eroded investor confidence. The central bank's actions against these agencies aim to silence critical economic analyses. This approach is akin to an ostrich burying its head in the sand. The CCP might hope to decelerate the stock market's decline, but the economic truths are evident to the mainland populace. The central bank should prioritize strategies to bolster the foreign exchange rate and the yuan's value, or introduce economic stimuli, instead of targeting rating agencies. From a capitalist viewpoint, such measures are deemed inept. Global stock markets have reached new highs since 2023, contrasting sharply with China's continued decline, suggesting dire economic prospects. Huang argued that China's leftward economic shift, state dominance over the private sector, and diminished global manufacturing role are key factors contributing to the market's poor performance, indicating a need for significant policy shifts to revive investor confidence and market optimism. As previously reported, amid this intense situation, Chinese investors directed their frustrations towards the U.S. Embassy in China. Utilizing the embassy's official Weibo account, they left comments under unrelated posts, imploring the U.S. to intervene in China's stock market and voicing vehement critiques against the CCP regime. Their requests ranged from seeking U.S. governance over China's stock market to pleas for military support, reflecting a profound disillusionment with domestic economic policies and governance. Liang Xiaohua interpreted these actions as a manifestation of dark humor from citizens under CCP rule, illustrating their deep-seated discontent and the lengths they would go to express it, despite the regime's tight control over free speech and public dissent. Highlighting the irony that CCP officials and their families often seek refuge in the West during crises, he noted the public's increasing tendency to air grievances internationally as a symbolic act of protest against the CCP's stringent suppressions, albeit with little expectation of practical outcome. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.